What is up, you guys? Welcome back to my channel. Nikki here, and in today's video we're going to be talking about QYLD. Now, is this the best monthly paying dividend stock for you to buy and add to your dividend portfolio? You already know the drill. Let's get it.
Ooh, big bad. You not talking money, you can miss me with the chit chat. I'm not with the rah-rah or the riff.
To be honest with you, these ones, just like the video I did on JEPI, which I will link down in the first comment below that you could check out after this video, but these freaking ETFs with the using the options, the covered calls, the buying the covered calls, all that kind of fun stuff, that real elite fancy stuff is a little bit over my head. I buy calls, I buy puts. That's really all I do in terms of options. So I really had to put on my thinking hat. I really had to do some education in this video, and here are just kind of my initial takes on QYLD, what it is, what it does, what it means, and honestly, if I feel like it's a good investment, because I think you might be surprised. Not like you should actually fully care what I have to say, or if I think you should get it, because you should always do your own due diligence. But you guys, let's just get to the basics here. So QYLD is a monthly paying dividend stock. It's around the $22, $23 mark as of this recording, which is November 10th, 2021. Its 5-year chart looks like this, and it's up about almost 4%, which is equivalent to like 84, 85 cents. And the dividend yield is in 11.3%, which means that this stock price every single month you're getting around 22 cents a share. That's pretty appetizing for a stock that low. So essentially, what is this? Like, just the basics here. So it's a NASDAQ covered called ETF that has a majority of its holdings in the technology sector as well as the communications sector. It has paid out every single month for the last 7 years, and as a long-term dividend investor, you know that that is extremely important. If you invest in a company to get paid a dividend, you best be getting paid your dividend. Now, the top holdings in this fund are pretty much big house names that we all already know. So these holdings start off with Microsoft being the most, and then Apple underneath that, Amazon, Tesla, Nvidia, Google, Facebook, also known as Meta Boys, Adobe, Netflix, and a lot more. Now, just right off the bat, we know that these are extremely high growing technology companies. Quite frankly, it's no surprise that somebody's going to want to take advantage of how to produce monthly income with names and movers like these. So they use a covered call option strategy, which quite frankly is just so damn confusing to me. Okay, I just want to put my money somewhere and pay me a dividend, or I want to trade options. I'm going to buy calls, buy puts really quick, get in and out, because that's how I like to do it. Like I said, they want to take advantage of these huge big growth companies to be able to pay shareholders dividends, because it's very appealing when you put names like Amazon, Google, Facebook, Nvidia, and you tell these investors like, yo, you're going to get paid every single month with names like these. But I think there's a lot under the hood here that not a lot of people pay attention to, and quite frankly, I think they don't, because they hear those names and they don't really understand what a covered call, because I didn't. Okay, I still kind of don't, but from what I've heard, it's low-key complicated, and I did learn a little bit, but I don't want this video to be a million years long, so I'm not going to go in depth on what it is in this video. But here's a breakdown of kind of how they can get to a place where they're paying us every single month. And in all honesty here, like, if they figured it out, then cool. I don't need to know how to do it. Just make sure you pay me what I'm investing in. That's really kind of how I think about it. But if, you know, we really want to dive deep and understand what's going on here the best we can, I'm going to try to break it down in the most simplest way that I might even confuse my damn self. So essentially what they're going to do is they're going to sell a NASDAQ 100 index option, and a premium price is paid for that option. And boom, they take and distribute the earnings from the premium to us as shareholders every single month. And this is a little bit different than a normal stock option, because it is an index. It has a little added security on it, just because it is a bit different. Because to exercise these options, meaning to buy 100 shares of said stock, can only be done on the expiration date, not before it. So if you tried to run this thought process and idea on a Tesla stock, let's say those options expire in 5 days, and on day 2 the stock price shoots all the way up. Let's say you bought a $650, I know it's like $1,050 now or something nutty like that, but let's say the stock price was $650 and you bought a $675. So in 2 days, if the stock shoots up to $675 or $680, whoever's on the other side of that can pay to exercise the right to buy 100 of your shares. And that's 3 days before the option expires. Now, if we're looking at an index, they can only do it on the day it actually expires. So same kind of concept here. If if we have the 2 days where it shoots up and goes past, over the next 3 days, maybe it comes back down, and instead of hitting the 675, it's at 650 still. Then no one's gonna want to exercise the right to pay over what it's actually worth. Does that make sense? I'm not losing y'all, because I low-key lost myself a little bit there. So what that lets QYLD do is keep that premium, and then they use that premium to pay us shareholders every single month. So this might, and it brought up a question for me, is like, okay, so what happens if it actually is a bull market and it runs up and it goes past that price? Well, they do what's called a return of capital. So if those options are exercised and they don't get to keep the premium to pay us, they use return of capital, which essentially is they're just giving us our money back as dividends. So say you bought this stock at $22. And years down the line, you're collecting that monthly dividend income, you're chilling, you're cool. But essentially what some of that dividend income is money that you invested in the first place, because not every single month are they going to be making and keeping these premiums. So they're basically giving you your money back, which is going to which then is going to make your average price of the stock lower. And over the course of those years, you're not paying taxes on those return of capital payouts, but they are tax deferred, which means they're gonna come back and nip you in the butt later. So when you sell, or if you sell your shares of QYLD down the line, they're going to be taxed as a long-term capital gain. So to be completely honest, in a bull market, this seems a little, I don't know. It's not that secure or safe in my opinion. And we didn't even mention the expense ratio, which is one of the highest I've seen at 0.6%. So essentially every $10,000 you have invested, you're paying $60 in fees, because obviously someone is in there actively trading options, but also managing all of that information. So that's a lot of information. It's a lot of confusion a little bit, but I think what it boils down to is if you're comfortable investing in something that could potentially like really kind of pull the rug out from underneath you and take back a lot of your money through taxes, through fees. I don't know. I just don't know about this one. I'd almost rather invest in something like QQQ, which is a very small dividend, but good growth. So at least you're getting a decent amount of income there with a lower expense ratio, but also QYLG, which is kind of a mix of the two, but you're still paying a pretty decently high expense ratio. The dividend's not as much, but you don't run the risk of that return of capital. So it's just kind of like you really got to think about your strategy here and what you're doing with these. And I know I talked about JEPI and I really liked that one, and like I said, I will link that video down below. But this one to me just kind of like, I don't know. I just don't know, because the names that they hold are so volatile. I mean, I just feel like it's a little unsure for me. I'm a little iffy on it. And for someone like me, I would rather just be investing in the company itself. I mean, I really do like JEPI, but I'm not gonna go like full throttle, full send into JEPI. And I'd never recommend obviously anyone going full send into one thing anyway. But for me, like, I'd rather just invest in good, solid ass companies that I love, that every time I buy a share of their stock, I just give myself a little bit of a raise. Now, I'm sure if you guys invest in this, you find way more positives than negatives, and you make it work around your investing style and your investing goals. So let me know down below what it is your goal is. Do you have this in your portfolio? Am I crazy for not having it? Am I crazy for doubting it? You guys, also, if you could smash the thumbs up button. If you are not subscribed and you like making money, having a good ass time, consider subscribing by hitting the NB in the bottom corner or the red subscribe button down underneath the video below. And if you do want to watch my take on JEPI, go ahead and watch this video right here, and you already know. If you made it this far, you're my most favorite people. I absolutely love you. And I will see you in the next one. Bye, guys.